Hi there, and welcome back to Investing Guide. Today we're going to be talking about what the US President Joe Biden has announced about cryptocurrency, and how it will affect the Cardano holders. The US President has announced a new infrastructure bill that contains a shocking last warning to Cardano holders. The President has signed the $1.2 trillion bipartisan infrastructure bill into law on Monday. The legislation includes tax reporting provisions that apply to digital assets like cryptocurrency and NFTs. Embedded into the infrastructure spending package signed into law by the US government was language that increased the tax reporting requirements for cryptocurrency transactions. That change was heavily opposed by the digital currency industry, which has in its corner a bipartisan group of senators that still hope to amend the law. Regardless, more struggles are ahead as Washington grapples with how Cardano and other cryptocurrencies should be regulated and taxed. So, how will all of this impact the crypto industry and Cardano in particular? And should you as a Cardano holder be worried about this? Stick around until the end of the video to find out more. But before we start, if you like this type of content, hit that like button, subscribe, and turn on notifications so you never miss out on any updates from the world of investing. Since the beginning of the crypto market, the government's had a keen eye on it, and have generated controversies and news about the cryptocurrencies. Similarly, the US government has talked negatively about crypto and points its role in the criminal activities and illegal recognition, thereby has refused to recognize it as a legal tender. Meanwhile, the new provisions signed by the US President Joe Biden could impact the crypto investors in two potential ways. First, provision will require each broker, which will mainly be exchanges, to report their crypto gains in a type of 1099 form. Brokers will also have to disclose the names and addresses of their customers. Also, businesses that receive payments of $10,000 or more in crypto must report the identity of the sender to the government, mirroring a similar anti-money laundering rule for cash transactions of that amount. However, according to the advocates of cryptocurrency, the provision's definition of a broker is too broad. Cryptocurrency advocates are concerned that the current language could potentially target those without customers, who wouldn't have access to the information needed to comply. In response to these fears, the US Treasury Department said in August that it would not target non-brokers, such as miners, hardware developers, and others. However, this provision will still impact cryptocurrency investors. A broker or exchange must send a Form 1099-B to both the Internal Revenue Services, the IRS, and their customers. The customer uses information from the form to calculate their preliminary gains and losses, which is then reported on their own tax return. However, Chandra Sekera, the head of tax strategy at CoinTracker, says that these 1099s are going to be inaccurate for the most part because these exchanges don't have the visibility into what you have in your own self-custody wallet or what you're doing with decentralized finance applications. With a self-custody wallet, investors own their private keys and cryptocurrency holdings, rather than using a third party, such as an exchange. Because of this, things could get tricky if an investor has both self-custody wallets and exchange wallets. Moreover, if an investor were to send $100,000 worth of Bitcoin from their self-custody wallet to their Coinbase wallet and then sell the funds, Coinbase would be required to issue a 1099 stating that the investor sold $100,000. But Coinbase will not know how much the investor initially paid for the Bitcoin because it didn't happen on the exchange. Second thing is, what are the implications for taxpayers? Potentially not too much, as the Internal Revenue Service already treated virtual currencies as property, so taxes are owed when it is sold or exchanged, similarly to a stock or bond. If the asset is sold for less than the original purchase price, it creates a capital loss that can offset other gains. Similarly, someone paid in cryptocurrency owes income taxes on it, and the IRS had already started cracking down on people not reporting their crypto transactions. It recently added a question to the individual tax return, Form 1040, prompting people to report any receipts, sales, or exchanges of cryptocurrencies. Another provision expands a section of the US tax code called 6050I to include digital assets. Section 6050I requires that people who receive more than $10,000 in cash and equivalents file a report with the IRS. The report states details about who paid them, including the name, social security number, and any failure to report any information about the people sending these payments is considered a felony offense. The infrastructure bill provision will require similar from businesses and exchanges when they receive more than $10,000 in cryptocurrency. While it doesn't have any direct burden on the end taxpayer, it will impact their privacy. The head of tax strategy at CoinTracker explains it as, say you buy a Tesla with 1 Bitcoin valued at $60,000. The car seller, the business, has to collect your personal information like your name, address, SSN, etc., so that they can report that to the IRS. This surveillance rule has been called unworkable and arguably unconstitutional by cryptocurrency lobbyists like non-profit Coin Center. Chandra Sekera further said that crypto people are privacy conscientious. Why would they want to give all their information to these businesses? Some of these businesses may not even have a good way to protect that private information, and that could lead to other second and third order consequences. Moreover, for crypto investors looking to stay on the right side of the law, which will be pertaining to their investments, well, there are 2 big things to keep in mind. First, they should keep track of their cost basis and what you originally paid for your crypto, as accurately as possible to reconcile with what the exchanges will be reporting to the IRS. Secondly, finding a crypto-knowledgeable tax professional could be even more helpful in accurately reporting your own crypto investments. Be as transparent as possible with regards to what cryptocurrency you hold and what you paid for it. While the IRS considered cryptocurrency taxable property before the new legislation, the defined reporting requirements raise the stakes for investors to make sure they're reporting their own activities accurately and completely. According to Maddox, I think a lot of folks are in for a big tax surprise. The IRS is going to be tracking this information, and there's no avoiding the tax consequences and gains now. Moreover, prior to establishing the law, the Treasury plans to take time to undergo research to understand who might be asked to comply and verify whether they'd be capable of doing so. A Treasury official previously told CNBC Make It. The process could take years. The provisions will not take effect until January 2024, and in the meantime, lobbyists within the cryptocurrency industry plan to push for amendments and standalone bills to adjust the provisions. Furthermore, this new bill signed in by the US president resulted in Cardano's price dropping sharply after it had previously reached multiple all-time highs in the preceding hours. Furthermore, the price of cryptocurrency fluctuates by the hour because of its inherent volatility. However, even the popular cryptocurrency is going through ups and downs. Experts recommend investing in Cardano over other cryptocurrencies such as Monero because these are less established cryptocurrencies as compared to Cardano. Moreover, after these new regulations of US government on cryptocurrencies, many celebrities and influencers are tweeting about crypto, and that could affect its value as an investment. Meanwhile, if we talk about Cardano and its price prediction in the future, then Cardano's price surged by as much as 400% during the year. Furthermore, cryptocurrency has been making huge waves in the investment sphere, with Bitcoin and Ethereum leading the top of the charts of the crypto market. In addition, Cardano being the new crypto in the financial world has increased its value and competition in the market. The native token of Cardano, ADA, has been ranked 6th amongst the leading 10 tokens in the world. Even though we don't really know what the future holds for ADA, we can consider positive possibilities for Cardano in the future, as the Ethereum killer Cardano has gained traction in the past year. Additionally, Cardano is a good investment option for long term, as it has been an excellent investment option for both new and existing crypto holders. Moreover, Cardano is working on new projects and building partnerships with larger companies. One of this recently powerful collaboration was with the Vast Bank. Vast Bank is the first federally chartered bank that allows people to buy, sell, and exchange crypto directly from a bank account. Standing at the forefront of cryptocurrency integration, customers of Vast Bank can buy and sell cryptocurrencies from any location in the US using the Vast Bank crypto banking mobile app. Earlier this year, Vast Bank became the first nationally chartered bank in the US to offer customers the capability to buy and sell cryptocurrencies alongside a traditional checking account, providing customers with the same personalized, convenient service they've come to expect from a leading financial institution. Vast Bank aims to set a standard for democratizing access to cryptocurrency by enabling customers to simultaneously manage both their bank and crypto accounts, side by side, in a high-tech and secure user interface, powered by world-class software. The Vast Bank crypto banking service is powered by Vast's integration with Coinbase and SAP. So these partnerships and developing network of Cardano will make it one of the most secure currencies of the future, and it will definitely increase its value. Remember, this video is meant only for educational purposes, and before you do any serious investing, consult your financial advisor first. While you're still here, go ahead and click on one of these two videos on your screen. See you there.